Welcome back to Revenue Margin. This is a podcast where we're going to continue to break down strategies and insights that drive smart business growth. I'm Rob Malenik, and today we're driving into two topics that every business owner should be keeping on the radar: sales and use tax and franchise tax reporting. Let's start with sales tax. It's normally collected from your customers, and you're doing it every single day, and you're paying it to the state. But what many businesses that are just getting to grow in other jurisdictions or maybe out of state don't realize that if you buy goods out of state and then they don't charge you sales tax, you may owe something called use tax. It's your responsibility to report it and remit it. If your business meets certain nexus thresholds in other states, like having employees or hitting certain sales volumes in a specific state, you're going to need to maybe register there. With economic sales and nexus taxes constantly expanding, changing every single year, and multi-state compliance is becoming more and more complex, it's very important for you to be able to look into this and understand it, because there could be significant penalties if you don't report this on a consistent basis accurately. Number two is franchise tax reporting. And this one is actually quite new from my perspective. It's been around for a while in other states like Texas and Delaware, but it's expanding at a local jurisdiction level like wildfire across the United States. What this is that franchise tax or business operations tax. It could be an employee tax that a certain jurisdiction is going to charge you just for being in operations within that jurisdiction. It's often it could be based upon net worth of your company. It could be based upon the gross revenue and receipts of your company. It could be based upon the employee wages that you have in that jurisdiction. States like Texas and Delaware are really widely known for it. But Kansas City, the city itself, will charge you a tax for having employees in their jurisdiction. Certain cities within Washington and California will charge an operations tax associated with the gross receipts within that jurisdiction. So missing some of these odd filings could cost you significant penalties. And what's worse, could jeopardize your ability to be in legal standing within that jurisdiction, causing your company to no longer be able to operate in that area. So I would suggest stay compliant. Think about this as a costly surprise that you don't want to hit you. And it's going to ultimately protect your margins that you have today. I know that you're having to pay a little bit of fees up front, but those fees up front will avoid significant penalties and legal fees up in the background if you don't pay these on a timely basis. There's automation tools out there that you can utilize, but then also you can utilize our VCFO services here at Creative Planning to be able to manage your multi-state reporting and registration requirements. Always, thanks for listening to Revenue Margin, brought to you by Rob Malenik. Please subscribe or press that like button at the bottom. Comments are always greatly appreciated. And we love to hear what's happening in your business, so please leave comments about what's happening in your business down below. Thank you so much. Have a wonderful day.